Good morning. You're watching Businessworld Live. I'm Danny Laurel. It's 9:30 a.m. this Friday morning here in Manila. We are just about to start trading. This is the last trading day of the week. But first, let's kick off with our top story. Moodys slashed its GDP forecast for the Philippines. That's as the country plunged into a recession in the second quarter amid the health crisis. The credit rater now sees the economy to shrink by 7% in 2020. That's steeper than its earlier contraction expectation of 4.5%. That is also deeper than the government's outlook of 4.5 to 6.6% of a contraction. Moodys cited the record fall of 16.5% in the second quarter, as well as bleak labor market conditions, a drop in remittances, and a decline in manufacturing output for its updated forecast. Moodys also affirmed the country's Baa2 rating, which it gave in December 2014. It also maintained a stable outlook, suggesting the rating will likely be retained over the next 6 months to 2 years. Moodys says the outlook reflects the view that recovery from what it described as acute shock from COVID-19 will restore rapid economic growth relative to peers. It forecasts a growth of 6.8% for 2021. That is higher than its initial forecast of 6.5%. However, the credit rater says the near economic term outlook for the Philippines remains uncertain. That is, as infections continue to rise globally, affecting remittances and key trade partners. Now, moving on to another story, inflation eased to 2.4% in the month of August. That's from 2.7% in July. You can see on our Bloomberg terminal here, the August CPI print is lower than economists' median estimate of 2.7%. The Philippine Statistics Authority attributes the August reading to a slower rise in the prices of food and non-alcoholic beverage, as well as in tobacco and alcohol. The year-to-date inflation now stands at 2.5%. Okay, guys, let's kick off with a quick health check on our local currency. Just amid that latest inflation print, you can see us actually strengthening a touch. We're at 48.573 to the greenback. Recall that yesterday, the peso had actually weakened further. That's as the U.S. government said it was targeting to distribute vaccines against the coronavirus disease by the end of October. So we had reported actually that the New York Times did mention that the CDC had contacted officials in 50 states. Documents put online by the New York Times showed that this will be available in limited quantities as soon as late October. So a lot of traders were saying that this would be ahead of the November elections, and that is what had actually put some strength on the dollar. But you can see now that as we gave an easing inflation print and lower than analysts had expected at 2.4% for the month of August, we are also seeing a strengthening in our peso. Now let's take a step back and take a quick peek at the markets offshore, because this was actually really very much in focus. You can see how the Nasdaq has pared back a lot of its gains. That euphoric uptrend is now bearing back. You can see that yesterday it had closed down by close to 5% really, and the benchmark S&P 500 down by 3.5%. This amid data over in the US for jobless claims had actually fallen. That was released yesterday, but still analysts are saying that US investors may need more evidence of a fuller economic recovery. Recall that there was a 60% run-up in the S&P 500 since its March lows. So global stocks are also ending the week with a sort of unwind. There was a recent global stock rally. We saw that up by at least 6% just in the past couple of weeks. There seems to be a rotation away from the tech stocks, and this is what investors are saying are causing a flight out of the Nasdaq and into other stocks here, as investors are starting to rotate that and questioning the valuations of these tech stocks. You can see here on my terminal how Asia is opening on the back foot. quick peek at the Topix, down by 1%, the Nikkei 225 as well. So backfoot in Japan, South Korea as well. You can see the Kospi down by 1.4%. Australia was also opening lower, but this, of course, compared to the losses over in the US, is not that bad. As I mentioned, the Nasdaq 100 sinking more than 5%, the largest decline since the month of March. Now let's take a quick peek at our own local index and whether we are following suit. It's been a very strange picture for our local bourse. But take a look at that. We're now at 5,600 levels, and this despite the fact that our inflation print was lower than analysts had expected. We are down by 1.3%, effectively joining the rest of the pain in the region following those U.S. shares decline. Now, yesterday actually saw us going against that and up by 0.6%. And this amid the unemployment figures that were released yesterday, which was at 10%, that was improving compared to the 17.7% print a few months prior. And this, according to PhilStocks, that was what had given the positive sentiment in the markets yesterday. It had shown that businesses have been slowly recovering. Plus, Luis Laminan had also mentioned, he's of course from Regina Cap, that the rise in the US stocks on Wednesday had spilled over into our trading day. There was a value of 5.3 billion being exchanged, but still net foreign selling at 1.12 billion yesterday. We can see a bit of a recovery here from a very strong and sharp decline. We're down by 1.2%. Let's take a quick peek at our sectors here and which ones are dragging down the index. You can see holding firms, the obvious laggard here, that's down by 1.7%. Property seems to be the only bright spot, that's up by 0.3%. But everyone else, financials, industrials, and services, sustaining more than 1% losses. So definitely bigger than the recoup, let's say, that we seen yesterday on Thursday's trade, and that we were hoping to extend into Friday. But let's take a quick peek at the biggest movers here. Ayala Land propping up the property index. Recall that this was one of the most heavily sold off stocks all week. It had seen 11 straight days of pain, and that seems to be recovering possibly as bargain hunters are swooping back in. That's up by 1.5%. BDO and SM Prime, the other two big guns that are in the green this morning. We take a quick peek at Aboitiz Equity Ventures, that is down by 3.6%. Speaking of Aboitiz, take a look at their power unit. That's also down by more than 2%. This amid the news that they said that they have halted the renewable power plant in Bukidnon. So this is in Mindanao. They have had to temporarily stop that. That's after persistent rains in the past had affected the operation. So this is Headcore Bukidnon. That's a 30.9 megawatt hydro power plant, and that will be being repaired until possibly the full restoration might approximately take 8 months, so still operational by May of next year. Now, just to understand, this Manolo Fortich hydro power plants 1 and 2 are actually 5% of Aboitiz Power's sellable capacity share in the energy market. So quite a sizable power plant there as Aboitiz is sliding today. Now, I did want to take a quick peek at our airlines here. Let's just take a quick check at those. And that is after some travel agencies. So this is the Philippine Travel Agencies Association, the PTAA, have said that the airlines owe nearly, get this, 1 billion pesos in ticket refunds for the canceled flights during the pandemic. This is according to an association that has 439 members. They said that refunds are due from around 27 airlines, including the likes of AirAsia, Cebu Pacific, and Philippine Airlines. So this from Candice Eog from Cebu Pacific. She's saying that because of the high number of flight cancellations, the refund requests are piling up day by day. Their backlog is about 5 months. You can see, however, Cebu Pacific opening unchanged this morning. And still speaking of airline and airport related issues, take a quick peek at Macro Asia. That's down 0.6% this morning. This as Sanli Airport proponents, of which of course Macro Asia is a part, are now seeking a fresh extension from the Cavite government. So this according to Cavite Governor John Vic Remulla, they are asking a 3-week extension. This is the consortium of Macro Asia and also China Communications Construction. They were already given an extension on June to be able to complete the submission of the requirements, but they did mention it's been very hard for them due to the lockdown. They already failed to meet their deadline the second time in June 11. And finally, just a quick peek on our telco players here and how they are faring this Friday morning. This, as the DICT has said, that 30 more firms are keen on common tower projects. This, as the government, of course, is stepping up efforts to reduce the red tape over in the telco space. They did mention that this is a welcome improvement. There are already 24 existing agreements with tower companies. Most of those are foreign-owned, so welcoming that 13 more common tower projects here. However, PLDT opening in the back foot, that's down by 2 2/10%. Globe down by 2/10%, and Dito Telecom down by 1 8/10%. So more on markets later on in the broadcast with AAA Equities' Matt Cabangan. Okay, give me a second here to just scroll down and check in on our largest headlines we're watching this Friday morning. The National Economic Development Authority, or the NEDA, sees unemployment rate falling to pre-pandemic levels by 2022. This is between 4 to 5%, provided the COVID-19 cases are contained and a vaccine has been made available. NEDA Chief Carl Kendrick Chua also said jobless rate may go down to 6 to 8% next year. That's in anticipation of over 2 million new jobs by 2021. These estimates by NEDA, however, are lower and slightly more optimistic than the projections released by the DBCC. The jobless rate is seen averaging 11% this year. That's following the latest July data, which was up by 10% year on year, but lower than the figure in April. Chua says there is a recovery trend in the labor sector, but it won't be quick. He said this recovery is still hinged on the vaccine being available sometime in the middle of next year. The central bank, meanwhile, says the July jobless figure may prompt some easing in banks' lending requirements and could reduce uncertainty among the business sector. Now, this from the Philippine Star. The rollout of new motor vehicles and motorcycles saw a double-digit drop in the first 7 months of the year. That's as the pandemic continues to affect operations. Data from the ASEAN Automotive Federation shows that the Philippines assembled 33,715 motor vehicles from January to July. This is 33% lower than last year's over 50,000 units. Philippines motorcycle and scooter output, meanwhile, reached around 270,000 units. That is 61% lower than last year's output. The Philippines is not alone, though, as all of its Southeast Asian neighbors also saw vehicle and motorcycle output decline in the first 7 months of the year. Sales declines were also seen across the board, with the Philippines posting a 49% drop in motor vehicle sales year on year, and with motorcycle sales sliding by 42%. The country's Chamber of Automotive Manufacturers earlier said they have submitted policy recommendations to the Trade Department that's to support the automotive industry as it struggles to pick itself up amid the pandemic. Tunnel boring for the first phase of the Metro Manila subway is expected to begin in the second quarter of next year. The Transportation Department Assistant Secretary Goddess Libiran confirmed this update to Businessworld. Libiran said the first tunnel boring machine is seen to arrive in the Philippines from Japan by January, while the second one will arrive in February and the third to sixth machines come in the succeeding months. Recall that some parts of the boring machine already arrived earlier this year. The DOTR, though, is still reviewing the bid of the joint venture of Sumitomo and Japan Transport Engineering Corporation for the rolling stock contract of the first phase of the subway project. Later today, the department will virtually present to the media the 6.99-meter tunnel boring machine that will arrive next year, which is currently in Tokyo. With unemployment easing, inflation staying low, and new COVID cases seeing their lowest rise in weeks, will our local markets finally catch up with the previous, let's say, global rally? Here to talk to us about his prospects, we have AAA Equities' President Matt Cabangon. Hi, Matt, and welcome back.
Hi, Danny. Always a pleasure to be here.
Matt, let's kick off with the general economy. Given this Moody's report, right? So it's going to be a bigger contraction than they had previously expected, but also a bigger rebound. And also they've maintained their outlook stable, and they haven't necessarily downgraded at least the debt rating. Is this not such a shocker anymore? Is this something that's moving the markets right now? Is there even some sort of psychological GDP contraction level that is keeping markets afloat?
Well, the GDP contraction that Moody's is projecting, as you said, is not really a big surprise anymore. They're really just following what we've seen in the past from institutions like the World Bank and the IMF, who have both also downgraded the Philippines' GDP forecast for this year. I think what the real story here is the affirmation of our credit rating and our credit outlook. I think that's a big vote of confidence in our market. And I think speaks a lot to how well positioned our government and our private sector are for bracing the next 6 to 12 months of this pandemic.
Okay, and this vis-a-vis the inflation print that came in below, not necessarily well below, but still below the forecast of the median estimates. Why is this not buoying our markets, at least at the open? Is this not something that traders are excited about?
Well, I think the fall in inflation here is really sort of just a reflection of what's going on around the world. There's no inflation anywhere, so I think we should be expecting the same story here. Now, the reason why it's not moving markets today is that we just saw U.S. markets fall off a cliff. Nasdaq down by 5%, S&P down by 4%. There are sort of bigger risk factors at play right now than the local inflation print. So to that end, while it does give us some confidence that consumers won't be crushed and that the BSP still has room to further ease, sentiment just isn't there right now to give our market the boost that it needs.
Okay, we'll go back to what the BSP is planning to do here, but let's talk about what you just mentioned, that we are basically feeling the pain which is spilling over from Wall Street. Why is that the case today whereas whenever Wall Street is rising euphorically, we don't necessarily feel that? So how connected or disconnected are we really to the global rally?
Well, here's the thing right now. We are still very much in the middle of this pandemic, and there's still so many unknowns. So our market is doing its best, taking its cues from larger, more liquid markets like the US. So we aren't so much tied to economic reality because we don't really know what lies in the next 6 months. So the primary driver of markets, both here and abroad right now, is sentiment, is investor sentiment. Unfortunately for us, because investor sentiment has soured offshore, it spilled over here. As to why we didn't participate in the mega rally that occurred in the US, well, that was largely driven by tech. Unfortunately, here in the Philippines, we don't really have listed tech companies. We don't have Amazons and Apples or companies like that. We are very much entrenched in the real economy. So industrials, energy, banking, things that even in the US haven't rallied much at all. So It's really been a tech rally offshore more than anything. And that's why we haven't participated in the upside, but have been victims on the downside.
Can you say that the global rally was not because of the, containment of cases or vaccine excitement? And why is that then not spilling over here? I mean, a lot of the rally, you mentioned, tech shares, but we've also seen just a broader based rally of the S&P 500. And a lot we're seeing that's also because of the economy in the US, these posting lower job losses and a possible vaccine by November.
Well, I think investors are a bit more savvy when it comes to tempering vaccine expectations. It's making the rounds in the news now that the fastest vaccine ever created was for mumps, and that took 4 years to develop. So I think people are taking these headlines of fast tracking vaccines with a grain of salt.
Okay.
Expectations that it's coming in January or sometime in Q1 next year, uh, I think is not what's driving people to be the marginal buyer of stocks here. It's something that people are hopeful for, but I don't think it's what builds the thesis towards buying equities right now.
Okay, let's move on to specific sectors here directly affected by possibly this inflation print. And you mentioned the BSP still having some room to maneuver. Let's kick off with the banking space. This has been, I mean, in my opinion, such a different rally for different sort of banks. You've actually got the profits of the largest banks suffering, but the smaller banks, post like China Bank, for instance, still posting a profit there despite the NPLs. What's going on here? Is there a discrepancy among the size of the banks? Who are the ones actually better positioned right now?
Well, we're seeing different earnings across different banks just because of their loan portfolio composition. So smaller banks like China Bank have much more concentrated portfolio exposure to corporates and SMEs versus, for example, BDO, which is much larger. Its exposure basically runs the whole spectrum of borrowers. So because you have a lot more retail exposure in BDO versus China Bank, you would expect BDO to be seeing a bit more loan losses than the smaller banks. But yes, sorry.
No, go ahead. And we also seen that in the NPLs. So it's just very different. Like PNB NPLs as of the end of June, 4.6%. BPI NPLs 1%. RCBC 3.4%. What's going on here? Is this really linked again to the retail loans versus the corporate loans, or just the way that the banks are managing their non-performing loans?
Well, anecdotally, from what I've heard speaking to companies and to business owners, a large part of these NPLs are driven by both consumer loans as well as some SME loans. So I think those are the two troubled sectors when it comes to NPLs. NPLs as a whole are kind of a lagging indicator. So this is damage that was done months ago. So I think we should be expecting more pain when it comes to seeing the NPL numbers. And that's really in line with what Governor Jokno has been saying, is that as we move forward, we will see that NPL number grow. It's not necessarily a sign of the future because, again, the damage has been done already. It's more a manifestation of that number, pulling up the Band-Aid, if you will.
Okay, and this SPV bill, is that expected to do much, or is that just a drop in the bucket when you compare it to the loans that are expected to not perform?
Well, right now banks are sitting on very strong capital buffers, and really that was affirmed by Moodys as well. Our banking sector is very, very healthy. What the FIST Act will do is effectively take away the bad loans that banks are exposed to and move that to government. The primary purpose of that is to improve the bank's ratios. So liquidity ratios, capital adequacy ratios. This will allow banks to direct their loans towards, higher quality ventures. Now, I don't think that that's the big question or the big barrier for the banking sector right now. I think the bigger barrier is on the demand side. Are there businesses and are there consumers out there who want to borrow? So yeah, we could fix this problem for banks and allow them greater capacity to lend. But ultimately, if there is no borrower on the other side, then this effort will sort of
the
fall
liquidity,
short.
yeah. Let's talk about those borrowers then and close off with the property space, Matt. Super mixed when you ask analysts about their outlook on the property space. I mean, there were all-time highs when you look at the biggest players. Ayala Land was one of the most heavily sold off due to the mall closures, etc. But then when you talk about this, when you talk to the smaller players, I had the Mosa Land yesterday, for instance. They're still pretty bullish. They're still saying residential is still growing. There's still a lot of demand when it comes to warehousing, BPOs, flocking to smaller areas. What is going on here? Is there going to be a fundamental repricing of these real estate assets, or will they be quick to repurpose?
Well, anecdotally, what I've seen from the real estate industry is a sort of bifurcated world right now. Residential real estate has been doing very well outside of Metro Manila, for example. And I think a lot of that could be attributed to something like the Balik Probinsya program. But then again, that's a one-off event, right? We have seen OFWs repatriate back to the Philippines. Again, another one-time event. So yeah, while we have seen a one-time uptick in real estate sales, I'm not sure if this is a sustainable business model, at least for our real estate companies here. So I think they see similar, and that's why they've cut back on capital expenditures. But overall, I don't expect Metro Manila property to be where the boom is. I'm looking outside. I'm looking non-Metro Manila and residential.
Okay, so still a very, risks are still tilted to the downside. And before we close, Matt, just index levels here. I mean, we're back to 5,600. I'm opening the terminal here. What's it going to be looking like? People have said the worst is over. We've now gotten, these prints from inflation. We've gotten unemployment prints. COVID cases seem to be getting lower, at least, day by day. So what are we hoping for right now? Is the worst over?
Well, the worst is over, I think, in terms of the real economy. Whether or not our stock market follows what's going on out there, which I think we didn't think was happening a few months ago, is an entirely different question. I think as we see more data now and really sort of start to digest how bad the damage is to our economy, I think there's real risk of further downside here in our market. Of course, I don't think that's going to be across the spectrum. I think some sectors are more exposed than others. So retail, for example, I think has a very, very rough year to 2 years ahead of it. While I think financials moving forward look pretty good. So it's going to be an uneven recovery in our stock market as far as the next year is concerned.
Okay, so the index, having said that, still feeling some losses here, down 0.8% to 5727.73. Thank you for that. And that was, of course, Matt Cabangon, AAA Equities' president. That's a first look into the business day. Today, September 4, 2020. Catch us again Monday morning, 10 a.m. I'm Danny Laurel, and we are Business.